Hi Team Value, JJ here, welcome back. Well, today we're going to look at more of what Bill Ackman said about investing. This is about the psychology of investing this time, how really important it is, and the aspects of that. Last time he was talking about the process of investing in the previous video. I'll put a link in the description to that if you haven't seen that. But this one, the all-important psychology, let's see what he's got to say.
Some big losses, some big wins. So it's been a roller coaster.
Mm-hmm.
So in terms of temperament, psychologically, how do you not let that break you? How do you maintain a calm demeanor and avoid running with the lemmings?
I think it's something you kind of learn over time. A key success factor is you want to have enough money in the bank that you're going to survive, regardless of what's going on with volatility in markets. People who, one, you shouldn't borrow money. So if you borrow money, you own stocks on margin, markets are going down, and you have your livelihood at risk, it's very difficult to be rational. So key is getting yourself to a place where you're financially secure. You're not going to lose your house, right? That's a kind of a key thing.
Good advice from Bill Ackman there, I think, about being secure, meaning that when you're investing money, you have to do it for over the long term. Say that you don't need it for 5 years, otherwise you get anxious. And if you're borrowing money and you can't afford to lose it and the market goes against you, it's hard to be rational. That makes sense. That it seems very hard to be rational when you're anxious about losing money and you might make some stupid decisions.
And then also doing your homework. Stocks can trade at any price in the short term. And if you know what a business is worth, and you understand the management, you know it extremely well, it's not nearly as, it doesn't bother you when a stock price goes down, or it has much less impact on you because again, as Mr. Graham said, the short term, the market's a voting machine. You have a bunch of lemmings voting one direction. That's concerning. But if it's a great business, doesn't have a lot of debt, and people are going to just listen to more music next year than this year, you're going to do well. So it's some combination of being personally secure and also just knowing what you own. And over time, you build calluses, I would say.
He's talking about music there, people listening to music more next year than they are this year. He has an investment in Universal Music, so that's what he's talking about, a specific investment there. But, knowing what you own, understanding the company, if the market goes against you, and this voting machine, short-term voting machine, long-term weighing machine. So as he said, stocks can go anywhere in the short term. If it goes down 50%, you have to understand the company and know what the company's worth, and then it won't bother you so much. I think it will bother you. Charlie Munger said you have to withstand a 50% decline in stocks in the short term. If you can't do that, you have no business investing in stocks. That's what he said. And that's what Bill Ackman's talking about here. When it can go down, they can go anywhere in the short term. So you have to have conviction in what you own.
So psychologically, just as a human being, is it as simple as just being financially secure? Is there some just human qualities that you have to be born with / develop?
I think so. I think, now I'm a pretty emotional person, I would say, or I feel pretty strong emotions, but not in investing. I'm remarkably immune to kind of volatility. And that's a big advantage. And it took some time for me to develop that.
So you weren't born with that, you think?
No.
So being emotional, you want to respond to volatility.
Yeah. And it's a bit, again, you can learn a lot from other people's experience. It's one of the few businesses where you can learn an enormous amount by reading about other periods in history, following Buffett's career, the mistakes he made.
I find it fascinating what he said there about learning the temperament, because a lot of people don't say that. They say that you're either born with it to be able to withstand volatility or you're not. But he's saying that's not like that. It's something he learned over time. When a stock loses, say, 30% after you've bought it, to not be bothered by that if you understand what you're buying. Because Buffett says that the intellectual is only part of it. It's mainly temperament, being able to withstand it. And what Bill Ackman's saying here is that you can learn that, or he had to learn that. Because his personality is definitely, as he said, he gets quite emotional. You can see on Twitter or X, he does get emotional about topics, but he says he doesn't in investing, but that's something that he's learned. Now, if you're getting value out of this Bill Ackman episode so far, I'd really appreciate it if you remember to smash that like button to help the algorithm to spread it to more people. It really does help. And if you're not subscribed already, do consider doing that as well.
Financially secure is something you, I believe, also recommend for even just everyday investors. Is there some general advice from the things you've been talking about that applies to everyday investors?
Sure. So never invest money you can't afford to lose, where it would, if you lost this money and, you lose your house, et cetera. So being in a place where you're investing money that you don't care about the price in the short term. It's money for your retirement, and you take a really long-term view.
So when he said be financially secure, he doesn't mean completely secure, having enough money for retirement. He's just talking long-term. So, not borrowing money or not investing money that you can't afford to lose over the next few years, say 5 years.
I think that's key. Never investing where you borrow money against your securities. The markets offer you the opportunity to leverage your investment. And in most worlds, you'll be okay. Except if, there's a financial crisis or, a nuclear device gets detonated, God forbid, somewhere in the world.
Or a pandemic or many of the other things that have happened. Black swan events can come out of the blue. And so if you're leveraged, then you can get really into trouble really quickly.
Or there's an unexpected war, or someone kills a leader unexpectedly. Things happen that can change the course of history, and markets react very negatively to those kinds of events. And you can own the greatest business in the world, trading for $100 a share, and next moment it could be 50. So as long as you don't borrow against securities, you own really high quality businesses, and it's not money that you need in the short term, then you can actually be thoughtful about it. And that is a huge advantage. The vast majority of investors, it seems, tend to be the ones that panic in the downturns, get over elated, and when markets are doing well.
This is how value investors have traditionally made money. People like Buffett, who just sit there waiting, are patient. When markets plummet or a stock plummets 50%, they go in and scoop it up while everybody else, many other investors, are selling. It's even when people say that they know what to do when things go down, but when it comes to it, they do the opposite, because it's this temperament, the psychological thing of knowing what to do, but then when it comes to doing it, actually doing it.
So be able to think long term and be sufficiently financially secure such that you can afford to think long term.
Yeah, Buffett is the ultimate long-term thinker, and just the decisions he makes, the consistency of the decisions he's made over time, and fitting into that sort of long-term framework is a very, very educational. Let's put it that way for learning about this business.
What do you think about mutual funds that for everyday investors that diversify across a larger number of companies?
I think there are very few mutual funds. There are thousands and thousands of mutual funds. There are very few that earn their keep in terms of the fees they charge. They tend to be too diversified, too short-term, and you're often much better off just buying an index fund. And many of them perform, they look, if you look carefully at their portfolios, they're not so different from the underlying index itself, and you tend to pay a much higher fee. Now, all of that being said, there's some very talented mutual fund managers. A guy named Will Danoff at Fidelity's had a great record over a long period of time. The famous Peter Lynch, Ron Barron, another great long-term growth stock investor. So there's some great mutual funds, but I put them in the handful versus the thousands. And if you're in the thousands, I'd rather someone bought just an index fund, basically.
This is something that Warren Buffett has said too. He thinks that people who don't do stock analysis or don't want to or aren't good at it, whatever the case may be, should invest in an S&P 500 fund. He said that many times. And he's talking about the very few fund managers here. People like Peter Lynch did very well, but there's so few and far between who've got enough of a return minus fees to actually do well for investors. What Bill Ackman's talking about here is some mutual funds have a huge number of stocks that are really just like the index, and then you have to pay fees on that, and they might not get a good return. He's talking about the vast majority, and I think it's over 90%, well over 90% don't beat the market return over time.
Yeah, index funds. But what would be the leap for an everyday investor to go to investing in a small number of companies, like 2, 3, 4, 5 companies?
I even recommend for individual investors to invest in, a dozen companies. You don't get that much more benefit of diversification going from a dozen to 25 or even 50. Most of the benefits of diversification come in the first, call it 10 or 12. And if you're investing in businesses that don't have a lot of debt, they're businesses that you can understand yourself. You understand, actually individual investors did a much better job analyzing Tesla than the so-called professional investors or analysts, the vast majority of them. So if it's a business you understand, if you bought a Tesla, you understand the product and its appeal to consumers, it's a good place to start when you're analyzing a company.
This is something that Peter Lynch has said too, starting with things that brands that things that you use every day, starting with things that we have on our phones here, the apps. Apple's done very well over time, Google. There are things around us, brands that we use all the day, starting with things that you actually know and understand. But what he's also saying here about the number of companies, I agree with this. I try to keep under 15. I do have fewer than 15 stocks. I'd like to get down to 10 long-term compounders over time. And Bill Ackman here has, as he says, he usually has well under 10, but he's very experienced, very focused. When you do make mistakes, big mistakes with a few stocks, it can really hurt. It's interesting what he's saying here. You get enough diversity with 12 stocks, with a dozen stocks, depending on what they are. Of course, some companies are diverse within them. If they're conglomerates, or Berkshire Hathaway is very diversified by itself, and there are other companies like that. Even Tesla has a number of different businesses inside it. So does Amazon, but some companies are just focused on one thing.
So I would invest in things you can understand. That's kind of a key. You like Chipotle, you understand why they're successful. You can go there every week and you can monitor. Is anything changing? How these new how's chicken El Pastor? Is that a good upgrade from the basic chicken? The drink offerings improving, the store is clean. I think you should invest in companies you really understand. Simple businesses where you can predict with a high degree of confidence what it's going to look like over time. And if you do that in a not particularly concentrated fashion and you don't borrow money against your securities, you'll probably do much better than your typical mutual fund.
Simple businesses. He likes these restaurants, fast food restaurants, and Chipotle's been the big one. He said he invested in it when it went down about 50%, when they had that health scare. He said that they've done very well out of these fast food chains. Simple businesses, easy to understand. Although to scale them up to the thousands of restaurants is a difficult thing for the business. But his point is that to understand the business, if it's something really complicated, some high-tech thing that you don't understand, then you shouldn't invest in it. It's just you have to understand the business. And as he said, it's possible for retail investors to do as well or better than mutual funds or fund managers, and have the right psychology for it, that right temperament in place, which can be learned. Now, as I said, I do agree with Bill Ackman about having a dozen or fewer stocks, being that focused over time. Any more than that, it becomes a bit unwieldy. It's a bit hard to understand more than that, or to follow and track that many over time. And I do talk about this on the Art of Value Patreon, how many stocks in the process that I go through. So if you're interested in that, I'll leave a link in the description and see you over there. Now, this is part of the Super Investor series that I've been doing at the moment, and I'm going to put a link here to the previous episode I mentioned about Bill Ackman, where he talked about his process of investing. So go and see that now if you want to. I'll put a link in the description as well for those watching or listening elsewhere. And thanks to everybody for watching or listening, and I'll see you in the next one.